All right, welcome to the Expect Success podcast, where we highlight real estate as an investment vehicle and speak to professionals who make it happen every day. Today, I'm joined by Chris Caffrey, and I always like to have people introduce themselves so they can highlight what's on their resume, how they view themselves professionally. So I will turn it over to Chris now.
Awesome. Thanks for having me, Eric. Yeah, so currently I'm a real estate coach. Primarily, I do have my license here in Texas as an agent. Haven't spent too much time on that side of the ball, but got pretty quickly involved with coaching on the commercial side. So I coach all different types of asset classes, multifamily, RV parks, mobile home parks, assisted living, short-term rentals, triple net. I've probably looked at it all. I think primarily, I coach apartments and in multifamily is kind of the focus. But personally, I'm in the middle of my second RV park / campground. The first one we closed in July, and this one we're in contract. We're looking to close absolute most aggressive, earliest end of the year, but probably more than likely sometime middle of January. So that's a little bit about my current. Before that, I was actually playing a little bit of professional baseball. I didn't make it to the big leagues, but I made it to some pretty good leagues. And, that was kind of, since I was a little kid, that's all I wanted to do. And my mom has been a real estate agent for the last 25 years. I think that's why it was kind of on my mind. And my dad's has been a pastor. Now he's a chaplain. And so anyway, just a little bit about my background and how I got into it. But I'll let you jump in with any questions if we want to go deeper in that.
Okay, well, awesome. Well, actually, let's start with your background. You said you came from a professional sports background,
Yes,
pro
sir.
ball. Do you think being in that world in pro ball, organized sports, do you think that has any impact on your career today as far as discipline or any way, or maybe not at all?
Yeah, no, 100%. I think, at that level of competition, like not just from a skill standpoint, but just like the mental side of it, you're playing 90 to 100 games in 4 or 5 months. So you pretty much 6 days a week. Your off day, off day is usually a travel day. Especially like, the minor league level, you're not flying pretty much anywhere. You're pretty much taking, charter buses and stuff. And so your body's sore, you're tired, you're, jet lagged, or not necessarily from a plane, but you're in and out of time zones and you're having to prepare your body. And people don't realize the mental grind of that. And at the same time, it's a performance thing, right? Like if you're not playing well at the professional level, there's, 100 people ready to take your spot at any time. So I think you have to learn how to handle the heat. You have to handle the pressure. You have to have a disciplined schedule, and you got to holistically take care of yourself. You have to work out and train. You have to get good sleep. I mean, there's a lot of things that I think from that high level sports will transfer into any job. But as far as like real estate specifically, what I've noticed is that, it's a competitive game, right? Like there's a lot of times there's multiple offers, or a lot of times there's, it's a speed thing on the post acquisition side, like how hard do you want to work to increase the marketing or to increase, the occupancy or to get the renovations taken care of. So there's a lot of work ethic, competitiveness, like being able to handle the pressure that translates to higher level like transactions that you kind of see with the big boys in the, in this arena, so to speak.
Okay, definitely kind of what I assume would be the answer, but everyone looks
Yeah.
at it differently. Okay, so that takes us to our next point then. When did you begin to pursue real estate as an investment strategy? I know you said your mother was in it, so it was always a part of your world.
Yeah.
And how did you land on the specific investment strategy that you did, being RV parks?
Yeah, no, great questions. So I think, seeing my parents do some like flips and some rentals, that trick, passive income is a cool concept, right? Especially for me in my playing career, until you get to the big leagues, like you don't hardly make anything, and a lot of people don't realize that you're barely scraping by, so for me, when I, taking note of the single family concept of like, okay, if I go get a couple rentals in 15 years, when the mortgage is paid off, like then I'll have some passive income. That wasn't super exciting. I was like, I just spent the last 20 something years of my life pursuing this career. And I don't regret it and I enjoyed it. But like the last thing I want to do is set off on another, 15 plus year venture. So I felt really, compelled to get my real estate license. And looking back on it, it's really just like God's faithfulness, because I didn't really even want to do much with it on the agent side, honestly, But after I got my license, I quickly got introduced to REI Accelerator. That's a company that I work for now. It's a great company that, coaches And that's what I do, is coach investors how to really transfer from single family, smaller types of, investments and mindset into commercial, bigger properties. But anyways, so when I started to learn like, hey, that, 15 plus year window can be shrunk into a, couple year window, depending on the size of property and how you go about it. I think that was a real game changer for me. So to answer your question, I started getting my license, I think maybe 2.5, 3 years ago, roughly. And then I started to, I jumped probably about a year and a half, close to 2 years ago, jump into this vein. And then, landed my first property, started working on it probably like 8 or 9 months ago. And then it closed about 6 months ago, and then took a couple months off, so to speak, in that, like, looking for something, personally. And then, last few months started pursuing this one and got in contract last month. So yeah. And then as far as the RV parks for an asset class, because, I was saying I typically coach apartments, and I'm actually probably more knowledgeable with apartments than RV parks, even though that's kind of the asset class I've landed on. Part of it's the market. What you see with RV parks currently is you have a lot of owner operated parks. You have a lot of mom and pop operators, couples, people who have owned the property for years. And you're seeing this transfer from owner operated to investor operated, right? So it's like right now is like, several years ago with apartments, where it like became like, hey, investors can jump on this. You don't have to like live there and do the property management yourself. Like, you can kind of do this from a distance and scale it. So I think it was the market itself, I think, is really hot for that, because you're seeing this transfer of owner operated asset. And this from, diving into leads. Anytime that you can connect directly to the seller, you're more likely to get a, better deal. So I think,
Absolutely.
what I've noticed as well is that this asset class, like a lot of the owner operators, they have it free and clear, which opens the door for seller financing. It opens the door for, like, there's a difference, right? When someone like needs to sell something versus they want to sell it. If they need to sell it, they probably have a price point that they have to hit. Like, hey, they got a balloon payment coming up, or that, they're coming up on their term. Like, they're not going to be able to take a loss. And if they do, you know what I mean? It's going to be last minute. Whereas with this asset class, I've noticed that if they're free and clear, it's a lot less of like a pressure filled competitive like process. And it's more so about coming up with the best potential offer that's a win-win. So both of these deals that I've done are seller financing, which takes
awesome.
banks out of the picture, which gives you a better rate. And, in the last several months, obviously rates have been super high. We've got one, I think, at 6.5. I think like starts at 6, goes to 6.5. And then this other one's at 5.5. Which you're not in that asset class, you're in really any asset class right now, you're not going to be. So that's kind of where I landed there. And then personally, I enjoy the creativity aspect of it. You have, if you have a park with some extra acreage, like sky's the limit. You can add some more pads, you can put some glamping sites in there, some cabins, you can, do what you want with that space typically. Whereas, money's money, good investment's a good investment. With the, multifamily side of it, sometimes you're just owning some concrete, which is fine. There's nothing wrong with that. So it's a nice mix up. Now, don't get me wrong. Like, I still think you're overall, like, apartments are king, but in this time period, for me personally, I've seen a lot of scalability and opportunity in that asset class.
Okay, awesome. That's really good. That's aggressive. Two deals within a year's time frame. That's really aggressive, which shows everyone just how active this passive income can be at times. You definitely have to start off with boots on the ground and putting in the work for sure. You said you know more about multifamily, and that's what you coach on. So just quickly, what do you think are some of the differences between the asset class of multifamily versus the RV park?
Yeah. Well, the stay structure is probably the biggest one, right? Like with multifamily properties, you're typically on like a 12-month lease. There's some properties with month to month, but your standard, deal is going to be 12 months. So this is the catch 22. There's a lot of stability in that. And I think that that's really comfortable as a, property owner to say, hey, this person's going to, they're here for 12 months and we're going to get our check. I think there's a lot of comfort to that. And, the benefit to that too is like, if you're going to go for like traditional lending or even like a refi, banks consider that to be very stable. Typically, if you had to go, if you weren't going to get seller financing, you had to go through a bank, you're going to get a lot. Well, I don't say a lot, but you're definitely going to get not as favorable financing terms on like an RV park per se. Because of that stay structure, they're going to see that as a liability. Now, the flip side of that catch-22, the positive thing on the RV side is that because of that, they know that they have to sell at a higher in-place cap rate. So a lot of times your day one acquisition on that asset class, you're going to be a little bit more in the positive, whereas the other side is, your financing terms may be more favorable, but they're going to be able to get away with selling it at a little bit more of a premium. So, and then like I said, typically what I've been running into a lot with the RV parks is it's owner operated. So you're going to have a little bit easier time, talking directly to the seller and kind of getting a free and clear type of LOI, right? Like, hey, you know that they're not like hurting for the cash, or they're not like in the negative. You're not going in there to work a miracle. They're free and clear, and you can kind of work a little better deal. Now, the other thing, the other positive on the apartment side is that it's going to naturally appreciate more, right? So like, the land or like the value at an RV park, like you're going to have to make upgrades and add additional spaces and things like that. Whereas with, multifamily, it's going to just naturally appreciate just because it's sitting there. So I think like that's definitely a plus on that, that side of it too. And like, the resale value, a lot of times, like you can, because of the in-place cap rate that you need to sell it at to make sense of it in the RV space, you're going to be able to be a little bit more aggressive in your sale price with multifamily. So I think it's like, there's certainly, benefits to each side of it. But I'd say the biggest difference is like the stay structure and how that impacts occupancy, how that impacts like appraised value. And then also as an owner, right, the stress of it. Now, some RV parks, you do own like the actual RVs and you're just kind of like renting them out or leasing them out, so to speak. Most of them you don't. And in the benefit there is your expenses can be down quite a bit because you're not having to work on repairs or maintenance of an actual living space. If they mess with their RV, that's on them. Whereas if it's your apartment and they mess with it, that's on you. I know we were talking earlier about the difference of RVs and mobile homes. Same thing there, right? Like if you own the mobile home and they're messing with it, like that's your repairs and maintenance costs. That's your expenses going up. And then if you just own the pad, you know what I mean? Another thing is the eviction process, right? So if you don't have to evict somebody who's like at an RV park is, they just kind of drive away versus like you're having to kick somebody out. So there's pros and cons to both for sure. I think, typically like there's different locations with RV parks play a big role. If it's a travel destination, a pass through, or like a long-term living solution, typically they're not really long-term living places. So that's where like demand and things like that, you feel a little bit more stable in the apartment side of things.
Okay.
Yeah.
You definitely speak like a coach because you went right into pros and cons as far as the asset classes, which is very strong. It's a very good way to present it. And a lot of good things I never thought about because I never looked at RV or mobile home parks as an asset class. So with that being the case, let's continue the theme of the pros and cons just a little bit. As far as your long-term strategy, is it buy and hold and refinance and sell? How does that strategy play into your long-term play with that asset class versus even say multifamily?
Oh, I got you. Yeah, I mean, I think it's all about scalability and also, as cliche as it is going to be like a deal by deal basis, right? For example, I don't think I gave much detail into the actual properties that I have, but the one that we're in contract with now is 197 acres and they're only utilizing 15 of those acres, right? So this is going to be like a multi-year, like, you know what I mean? Like we feel like we can really like continue to reap benefits out of this for years to come. Whereas if I'm on like an 8-acre lot and I'm pretty close to the ceiling of like, what I can charge, you know what I mean? I'm probably going to be a lot more apt to be like, okay, someone comes in with a nice check, like, you got it, or a nice refi, then maybe it's, maybe it's time to transition. But this particular project is more, there's more to reap out of it just because of the sheer size of it and the opportunity there. So I think like typically speaking, if I can put management in place and, have it run at least like mostly as good as I could run it personally, then I don't have an intention to like just get out of there. But if I'm in a situation where I'm like, we're pretty much capped on potential, and someone comes along with a good offer, I think I'd be willing to transition it out, if that makes sense. So to answer your question, I think diversifying is probably ultimately my goal, is to eventually have some like long-term assets, which I feel like this one in Vermont will be like a long-term asset, and then have some that are more, flip, or not necessarily like a quick flip, but like, 2 to 3 year flip, or something to where you're, kind of just building capital. And then eventually I'd like to be a limited partner as well, where that is completely mailbox money, because, the general partner side, your advantage obviously is you control the destiny of the property. You make the decisions, you oversee, and you have typically a little bit more, you have more skin in the game for sure, but you also can get more reward out of it. But on the limited partner side, I mean, we're talking, I know I'm kind of going on a rabbit trail here, but that's really true passive income is on the limited partner side. And you can really start to build infinite returns. And what I mean by that is, let's say, Eric, you say, hey, I want to come in to your Vermont project. Here's 100K, and you're going to make returns, from the beginning off of that 100K. But then, let's say a couple years down the road, I refinance, I give you your 100K back, plus what you would have made off of just your returns in that time. But in a lot of the structures of the deals that I do and I coach people to do, is there's a piece of equity as well. So you just got your 100K back plus some returns, and you also have a piece of equity. So now you have zero skin in the game, and you have the ability to still collect checks from that property. Whereas, tell me what happens if you put your money into crypto or stock, what happens when you pull your money out? You're done. You know what I mean? They're like, we've got no more obligations to give you anything, right? So that's really like, I think my long-term goal is to have a couple, properties that I'm, the GP on, adding to, scaling, building up like this one in Vermont, and then also like start putting some money into some of these limited partner projects and just letting it kind of, grow organically.
Okay, awesome. Yeah, you definitely spoke to a lot. And one of the things I did want to ask you is, it's a little off the original questions, but I think we have a little bit of time for it, is the seasonality. Yeah. You kind of alluded to that with the financing and the banks and stuff. How do you work in the seasonality aspect of the RV park? Because you said it's in Vermont. That's going to be a wildly different market if you have an RV park in Florida. So how do you work that into your initial assessment?
Yeah. So when you're underwriting, you want to make sure that there's like a consistent theme. Now, this is just my take on it, right? You might have people who are more aggressive, or, maybe have done these kind of miracle projects, so to speak, and they're comfortable with that. Personally, I want to see, what am I inheriting day one? Like what has this park been producing? So what do I know? Like worst case scenario, what's my safety net? And for me right now, this may change in the future, but at the moment I need to be cash flow positive day one. So whatever they're doing right now, whatever measure of success it needs to be for me to be cash flow positive day one, that's what I need to feel good about it. So what that looks like on a seasonality, concept is, if I'm looking at the last 12 months and I see like a great June, a great July, a great August, great September, October's okay, November's really bad, December's awful, right? And then if I only have 1 year of those financials, I'm just really guessing. But if I can look back 2 or 3 years and I see, okay, these months do great, these months don't, that's going to give me an idea, like I said, what I'm inheriting day one. Now, there's certain things that I'll look into to see if I have solutions for that, right? So, for example, like to hedge for seasonality, a lot of times, like you look for some more longer term stays, more longer term occupants, so to speak, not really tenants if you don't own the actual property or the homes, but you search for some of that. Now, Vermont's park is only open 6 months of the year at the moment. So that kind of takes care of it on its own. But on places that are open all year and you have some of those slower months, usually in the winter, you can hedge for that by trying to kind of push your marketing more towards longer term stays. And then you try to, hedge those few months with some longer term stays, because you're not really going to get people like coming in for a day or 2 days in, the middle of, January or something. When you're underwriting, you want to really see like, what do they have going on right now? What are their kind of consistent trends? And then how can you keep doing what they're, you see these like business surveys, right? Like the start, stop, keep things, and it's the same concept. Like, what are they doing right now that I want to keep? What are they doing right now that I want to get rid of? And what are they not doing that I can start doing? So if I can see a consistent theme in my underwriting, then I'm certainly going to, do that. I'm going to keep doing what's working. I'm going to stop doing what's a waste of money or, what's clearly, not progressing them forward. And then I have some ideas too, like, hedging for those off months, or maybe running some promotions, right? Maybe I've got a big space and I can, bring some food trucks or have a concert, or, you know what I mean? Do some, connect with the community, see if there's any, grants available. If I add a big pavilion on my property and occasionally have a chamber of commerce meeting there. So, you know what I mean? Like, there's different things I can do to but I have to see what they're doing right now to see if it's something that they're not already doing. A lot of these owner operated places, man, are really outdated, right? Like, you can just go on the website and you're like, man, this is from like 97, or like this hasn't touched, or, you know what I mean? Like, there's very clear like value add situations. And then there's opportunities where it's like, man, these guys are doing absolutely everything and they're scraping the barrel. And that's what I'm going to be a little bit more gun shy on.
Okay. And again, you answered so much and led us right to the next topic anyway. When assessing, say, like a multifamily, how do you assess the value add potential in an RV park versus, say, a multifamily? Like, how do you look at the pros and cons with the value add from one class to another?
Yeah, no, great question. So for me, I think the two things that I look at initially in my underwriting is like I mentioned, the current, what am I inheriting day one? And then the financing, right? So like, a lot of times it's more, I'm sure you've heard like, your price, my terms, or, my price, your terms. And so I think like, I'm trying to create this with value adds. I'm trying to create this margin. That could be on day one because I get it at such a discount. The margin's like baked in, or it's like I'm here and I need to add value by either increasing rents or adding spots or like adding amenities. In the multifamily side, you're talking about covered parking, gyms, pools, you know what I mean? Laundry, just different ways to, paid parking in some areas. Whereas with RV parks, you're usually going to be like more pads or glamping sites or cabins. Or a lot of times with RV parks, the first thing that you should really do is try to just increase the occupancy. Because across the board, if you look at like the metrics, you're going to be like 60 to 65%, I think would be like your average occupancy across the board with RV parks, which a lot of that is because there's that mixture of stay structure, right? You have the transient, you have the, 1 monthers, then you have some places where you're going to have 6 month plus. Whereas on the multifamily side, that like you're looking for longer term solutions. So really like the biggest play with multifamily is, there's three ways to add value with multifamily, either to increase rents, decrease expenses, or increase the occupancy. You know what I'm saying? And so it's pretty straightforward. Whereas on the other side is where I think the occupancy should be super highlighted, is because without the occupancy, like you got nothing. But if I have demand, now I can get creative, right? Like, do I know that this area does really well with cabins? Or, is there a lot high demand with short-term rentals in this area? Maybe I'm in a travel location, right? So if the occupancy and the demand is there with the RV space, then I have something to work with. And then also obviously the size of my property. If I'm already like a glorified parking lot, my only play is going to be, decreasing expenses and increasing the rents, right? But if I have space and the demand is there, the sky's the limit. And that's a thing that I enjoy on the creative side. But yeah, multifamily, it's pretty straightforward. Like, can I increase the rents? Can I decrease expenses? Or can I increase the occupancy? That's going to be my biggest thing, draw.
That's awesome, because with the spot in Vermont, you said it's 196 acres, correct?
97. Yeah, 197.
197. So you have a lot of leeway to be creative and test things too, if they work or not. And like you say, get to know the market and what works and what doesn't. But with that much expandable area, you have room to play around and diversify. And I know event venues, maybe not for Vermont, because I don't know that area, but I know event venues on larger land like that is a good cash cow. You generally can be a value add.
Absolutely. No, that's a great point. And what you say kind of reminds me of, with that asset class, a lot of there's mobile cabins, you can kind of like roll them in, or, like glamping tents and things like that. Like, if it doesn't work, it's pretty easy to remove and try something else. Whereas if you build like, a construction, like, you build an apartment or home or something like that, that's going to be, you're kind of stuck with it. So, I think there's a little bit more room for like experimenting, creativity there. Whereas on the other side of it, by far, I think the biggest benefit, or let's say the top two benefits for me would on multifamily is that the stability of the longer term lease structure. And also like, it's a lot easier to manage like from a distance. I think you have to be really confident that you have somebody taking care of your stuff, if you're not going to personally manage the campground or RV space, because a lot of it, it's a tight knit like community. A lot of times, like a lot of times, a lot of the parks look the same. Now, granted, I've been blessed because both of mine are very like scenic and they're really nice, like lots of trees, and it doesn't feel like a parking lot, which I've seen a lot of parking lots, out there, campgrounds that look like parking lots rather. But all that to say, like, I think you're really like benefiting from creating that community, in that asset class. So that's like, whereas apartments, you know what I mean? You need someone, to manage them and just kind of do a good job. And yeah, it's not great if they don't have a good attitude, but it's not the end of the world. Whereas if like, you got this, not, guys are camping, they're, in a good mood, and then they run into the manager and have a bad situation, they're probably going to go across the street to the other campground, right? So I think
Absolutely.
management is easier with multifamily, and I think that the stability side of it is a little bit more comforting, so to speak.
Well, I know for me, this was definitely eye-opening. I've never looked into RV parks as an asset class. For lack of knowledge, nothing more than that, just a pure
Sure.
lack of knowledge. But thinking about the possibilities and hearing you explain it, it sounds like you have a possibility to add more of an experience with
Mm.
an RV park versus an apartment complex, because yes, you can do the amenities, a gym, pool, whatever the case may be, and work with what you have and build on what makes sense. But with an RV park, I did hear a story before where someone actually added a petting zoo and added like a farm, so made it part of the actual living experience. It wasn't directly it was on the property, but not like, the guests could go visit it and make a day of it. So that's
Yep.
definitely awesome. Chris, we are kind of at time. So I wanted to just, you obviously know what you're talking about and you are a coach. What is the
Right.
best way for people to connect? Not absolutely well deserved. What is the best way for people to reach out and connect with you if you're open to that?
Yeah, absolutely. Or I think I've seen you post this on LinkedIn before. LinkedIn's a great place. You can shoot me a message on there. You can follow me on Instagram. I don't really post too much like business stuff on Instagram, but I will respond. If you shoot me a message on there. I think my username is Chris letter D Caffrey, all in one. But I think LinkedIn would probably be the easiest way, especially if it's a business thing. So yeah, so a couple different things. As far as coaching, I am taking a few more clients. You know, if that's kind of what you're looking for, investing wise, these projects like the one in Vermont, we're in contract with and things like that. There's opportunities to jump in on the investing side and the passive income side. And then outside of that, I'm happy to communicate and chat. I'm up here in Fort Worth, Texas. So, I'm always looking to build relationships and build bridges with other professionals in the industry or just in general. Erik, I appreciate you, man. Really good questions and looking forward to continuing our conversations as well and potentially building something, man. It'd be fun to connect more on that.
Absolutely, because you just, again, hearing you speak, and I've heard you speak before, I definitely know who we need to go to for the advice, and I appreciate it.
Great.
Definitely went a little over time. I appreciate your time as always, and everyone for listening. Just wanted to say to everyone, and remember, with a game plan and consistent action, you too can expect success. Chris, thanks again.
Yes, sir. Thanks, Erik.